Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Dan Lefkowitz sees a brighter outlook for dividends this year. Mike Hodel finds dividend opportunities for 2021. Christine Benz helps investors to assess their financial goals. Russ Kinnell lists the pros and cons of various investment vehicles. And Christine Benz shares her January financial to-do list. So let's get started. Dan Lefkowitz from Morningstar Inc. and Holly Black from Morningstar UK discuss dividends in 2021.
Welcome to Morningstar. I'm Holly Black. With me is Dan Lefkowitz. He's a strategist at Morningstar in Chicago. Hello.
Hello, Holly.
So Dan, you've been looking at the outlook for dividends for the year ahead. But before we get into that, it's probably worth looking at dividends in 2020. And it was a bad year. What went wrong?
Yeah, if you look at Morningstar index families that track dividend-paying stocks around the world, they badly underperformed broad global equity benchmarks. And there were really several factors at play. The pandemic and the related economic downturn hit many dividend-related sectors very hard. And then as equities rebounded across the world, that bounce back was really led by technology-related businesses that are not so rich in dividends, companies that were benefiting from the work from home and shop from home trends, and not so much companies in dividend related industries and sort of economically sensitive areas related to consumer or basic materials and energy, financial services.
So I think something we notice quite often is dividend payers tend to be in those value stocks or more cyclical industries, and they did struggle. But we saw a value bounce back at the end of the year. So does that mean we're going to see a dividend bounce back?
Right, absolutely. So if you look at growth stocks versus value stocks over the course of 2020, the gap between growth and value was the largest since the late 1990s, the dot-com TMT bubble. And dividend payers tend to be on the value side of the market, as I mentioned, in those old economy industries. That was for the overall year, but there was something of a rotation in November. So first we had the U.S. election. The market interpreted the outcome as relatively benign, if not positive. And more importantly, you saw promising results on the vaccine front. And so as the market anticipated economic recovery and a return to normal, that benefited a lot of economically sensitive sectors of the market, including a lot of dividend payers.
So Dan, let's be brave and put our forecasting hats on. What's your outlook for dividends this year?
Yeah, we're positive. It's of course very hard to know what's going to happen in the short term, but we know that over the very long term, dividend-paying stocks are good bets. They tend to be solid businesses. We know that a substantial portion of the long-term total return from equity markets actually comes from dividends, from reinvested dividends, from dividend growth. We know that dividend businesses tend to be solid, more stable in their cash flows, and we know that that commitment that a dividend payer makes to pay out some cash to shareholders on a regular basis instills discipline and causes corporate management to steer a prudent course. And then we have to talk about yield. So the yield on our Morningstar Global Dividend Yield Focus Index, for example, is well above 4%. That's more than double that of the yield on the broad global equity market. We know that yields on most developed world government bonds are really paltry. Interest rates have been cut and are extremely low. We know that there's an aging demographic in much of the developed world that is looking for income in the equity market. So there's a lot of factors really that should be beneficial to dividend-paying stocks going forward.
So are there any areas that you see as particularly well positioned to come back and start paying decent dividends?
Yeah, well, it's really critical to be selective when it comes to buying dividend-paying stocks and chasing yield. Looking for the most yield-rich areas of the market can often lead you into troubled areas and dividend traps. Companies that have a nice-looking yield, which are ultimately unsustainable. So you have to really screen for dividend durability, sustainability going forward. So we look for well-positioned companies that are financially healthy, that can sustain their dividends going forward. So if you look at our Global Dividend Yield Focus Index, some of the areas that it's favoring, big telecom stocks, for example, AT&T is a stalwart name in the index. Some consumer-related businesses, so Nestle, Procter and Gamble, Unilever. On the financial side, the Canadian banks screen very well on our dividend sustainability metrics, and then some technology as well. So Broadcom, Taiwan Semiconductor, Samsung Electronics, and then some pharmaceutical names, including some of the businesses that are involved in the vaccines for COVID.
Dan, thank you so much for your time. For Morningstar, I'm Holly Black.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Now, Mike Hodel from Morningstar Research Services highlights some dividend picks.
Since we first started this dividend stock video series at the start of 2019, we've highlighted stocks across a variety of sectors, including tech, financials, energy, and telecom. But we haven't looked at two traditional sources of dividend ideas, consumer staples and utilities. This time around, we'll rectify those omissions with two new dividend ideas and then review a handful of past ideas that we still think are attractive. Among consumer staples, Kellogg is currently one of our analyst favorites, trading at a 25% discount to our fair value estimate, and it provides a nearly 4% dividend yield. While perhaps best known for its long-standing breakfast cereals, the firm has spent the past several years remaking its product lineup. On-trend snack items now account for around half of total sales, with cereal only around 20%. And recent acquisitions like RX Bar provide both solid growth potential and give Kellogg avenues to respond as consumer tastes change in the future. Turning to utilities, we don't think utility valuations have been particularly interesting in recent years, as low interest rates have lifted valuations across the sector. Utility shares typically get interesting from a valuation perspective when something goes wrong, and that's certainly the case with our utility pick this time around, Ohio-based First Energy. The stock has tumbled over the past year and now trades at a 30% discount to our fair value estimate, providing a yield in excess of 5%. The past decade has been challenging for First Energy as its merchant power business ended up filing for bankruptcy protection. That issue was finally resolved in early 2020, allowing the core utility business to move forward. But shortly thereafter, though, the firm was caught up in another controversy surrounding alleged bribery to support passage of legislation in Ohio, leading to the arrest of the Ohio House Speaker and the resignation of First Energy's CEO. Despite this latest challenge, though, First Energy's underlying businesses are in good shape. Its Ohio electricity distribution business, which only accounts for about 20% of total earnings, have base rates that are fixed over the next 3 years. And the remainder of the firm's businesses include distribution assets in other states and its federally regulated interstate transmission operations, which we expect will account for around a third of earnings by 2024. While we haven't highlighted utilities in the past, we've certainly recommended a handful of energy companies, 3 in fact, over the course of this video series: Exxon, Enbridge, and Enterprise Product Partners. While oil and gas prices have rallied recently, shares of several energy firms still look attractive to us, with extremely attractive yields, including each of these 3. Exxon trades at a discount of greater than 40% to our fair value estimate, with a dividend yield that's now in excess of 8%. The firm has reduced capital spending recently to protect its dividend, but it still plans to invest enough over the coming years to double its earnings for the decade through 2027. We still believe Exxon is the strongest integrated energy operator globally, with opportunities to invest at attractive returns on invested capital, and that the market has overly discounted its prospects, and management has repeatedly reiterated its commitment to the dividend, and the balance sheet is in decent shape in our view. But we still think oil prices will likely need to recover for the dividend to prove sustainable over the long term. Enbridge has also faced ups and downs since we discussed it at our mid-2019 dividend video, but we still expect the firm will be able to bring all of its major pipeline expansion projects online by 2023, fueling solid earnings growth. The stock still trades at about a 25% discount to our fair value estimate and offers an 8% dividend yield. Enbridge carries a fairly heavy debt load, but we expect its more utility-like operations will continue to provide solid dividend coverage and support for the balance sheet for the foreseeable future. And finally, we turn to Enterprise Products Partners. Similar to Enbridge, fee-based services and products make up a large percentage of Enterprise Products earnings, 80 to 90% by our estimate, with heavy exposure to contracts and services that aren't heavily dependent on transportation volumes. The firm's operations also are diversified across a variety of end markets and service types, with things like petrochemicals and storage offsetting weakness in the current oil markets. The shares trade at a greater than 20% discount to our fair value estimate and offer a 9% yield. And we think the partnership units are still attractive.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, Christine Benz from Morningstar Inc. helps investors rethink their financial goals. The coronavirus pandemic has rattled the financial foundation of many households. While there have been signs of life in the economy, the U.S. unemployment rate remains stubbornly high, and GDP growth has declined around the world. Morningstar's Christine Benz says many people are rethinking their financial goals.
Many households have experienced income shocks and have burned through their cash reserves, illustrating the critical role that holding liquid assets play in the health of any financial plan. Everyone should set an emergency savings goal based on their employment status. Gig and contract workers should save more than 3 to 6 months' worth of living expenses because they're at greater risk for more frequent work interruptions. Additionally, higher income workers may need a larger savings cushion because it may take them longer to replace their jobs if they've lost them.
While it is important to have some liquid cash on hand in a checking or savings account, a Roth IRA can be a great place to park some emergency funds.
In a best-case scenario, the Roth assets would be left undisturbed until retirement. But in a financial crunch, the account owner can withdraw his or her contributions without any taxes or penalty at any time and for any reason.
The pandemic has left many individuals unemployed, but the Labor Department reports that older adults are one of the hardest hit groups and have a harder time finding a new job. Some are likely considering early retirement. Morningstar's Christine Benz says early retirement isn't always in an investor's best financial interest.
If you're contemplating retiring earlier than you expected, think about sitting down with a financial advisor to model out your cash flows in retirement on a year-to-year basis. You also want to make sure that you model out Social Security benefits with different start dates. Delaying the start of Social Security benefits will lead to higher benefits throughout your lifetime, and this can have a major impact on the health of your plan.
Go to Morningstar.com for info to help you get your financial house in order. Now, Susan Jabinski from Morningstar Inc. interviews Russ Kinnell from Morningstar Research Services.
Hi, I'm Susan Jabinski with Morningstar. Mutual funds have enjoyed tremendous growth during the past few decades, but other investment vehicles are gaining attention. Joining me today to discuss the pros and cons of some of these products is Russ Kinnell. Russ is Morningstar's Director of Manager Research and editor of Morningstar Fund Investor. Hi, Russ. Thanks for being here today.
Glad to be here.
Now, in a recent issue of Fund Investor, you scored various investment vehicles on a handful of traits, things like costs, transparency, and diversification. Tell us a little bit about the traits you were looking at.
Oh, yeah, I'm just interested in what some of the key differentiators between all these investment vehicles, because I think investors are facing more and more vehicles. So I looked at cost, transparency, regulatory structure, really just to kind of get at what are the key drivers of differences, because I think more than ever, people have a lot to evaluate because there are more and more choices out there.
And, you know, looking at your results, it looks like ETFs in general scored pretty well across most of those traits. Is that right?
It really is. They're great for liquidity, transparency, generally fees. There are some higher cost ETFs, but generally ETFs are following passive strategies, and there are some very cheap ETFs. And then on top of all of that, ETFs have some favorable tax structures that make capital gains distributions pretty uncommon. So there's a lot going for ETFs. It's not an accident that ETFs have taken in so much money.
And let's talk a little bit about collective investment trusts, or CITs. These are gaining traction among 401k plans and, of course, government-sponsored retirement plans. How did they look?
Yeah, you know, they're a lot like mutual funds. You have typically the same managers pursuing the same strategies of a diversified portfolio, but they have a different regulatory structure, which is a little less demanding, and therefore that means that they can be a little cheaper. And so that's why you're seeing 401k plans switch, and you see a lot of Fidelity or T. Rowe Price where they have almost identical CIT to one of their big core equity funds. And so you can get them for a little cheaper. Really, the biggest downside is there's a little less transparency on portfolios. And if you enter all of your holdings into a portfolio tracker, you may not be able to put that CIT in there. So you have to use the proxy mutual fund. So it can be a little annoying to some people, but obviously there's a cost benefit. And if it's a T. Rowe or Fidelity clone of a mutual fund, you know what you're getting, really.
There were two vehicles in particular, variable annuities and hedge funds, that didn't score particularly well throughout some of your metrics. Can you unpack the pros and cons of those two investments?
Oh yeah, two very different investments. Obviously, one is sold on safety, and the other is kind of meant to be cutting edge or a strategy that will hold up well on a down market. But I think the underlying weakness of both of them is costs. Typical hedge fund might charge 2% of AUM and 20% of profits. Variable annuities typically have very big commissions. If someone's trying to sell you a variable annuity, it might be a good deal, but they're probably getting a pretty hefty commission on it. So you want to look very closely. And my other issue with hedge funds is simply that generally the best ones go to the big institutions. So even if you're an investor with enough money to get into a hedge fund, generally those for the masses or even the relatively wealthy are the second and third tier hedge funds. So you may be getting, Ritz-Carlton prices, but Motel 6 quality of hedge funds. So I don't think hedge funds are great for a lot of individual investors.
And then lastly, how did mutual funds stack up?
Mutual funds, and I kind of use that as my base case versus everyone else because I think they're the best known. Mutual funds are particularly good, I think, at transparency, regulatory structure. There's very sound structure around mutual funds. Where they're not always as good as fees. There are some very low-cost fee funds, but there are some higher-cost ones. Most mutual funds are actively managed, so that's the main reason they cost more than ETFs. But you certainly have to be careful with mutual funds. Mutual funds have some of the commissions embedded in them as opposed to ETFs. So costs are one element. Another is capital gains. The capital gains structure around funds is a little less enticing than ETFs. Again, an index fund is probably going to be fine from a capital gains standpoint, but you do see actively managed mutual funds tend to be less tax efficient. So if you're buying for a taxable account, ETFs or passive mutual funds are often the better idea.
Well, Russ, thank you so much for your time today and helping us sort through all these different investment products that we have to choose from.
You're welcome.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
Lastly, Susan Jabinski asks Christine Benz about her January financial to-do list.
Hi, I'm Susan Jabinski with Morningstar. If improving your financial well-being is on your to-do list for 2021, you're in luck. Morningstar's Director of Personal Finance, Christine Benz, has developed a month-by-month financial to-do calendar for the year. And she's here today to talk with us about what should be on our to-do lists in January. Hi, Christine. Thanks for being here today.
Hi, Susan. It's great to be here.
Now, you've been assembling these calendars for the past several years. What's the thinking behind them?
Well, the thinking is that many people do have improving their financial well-being as a goal. And the idea is that if you break it into more manageable steps, it makes it more doable. And it's really like any goal that we might set for ourselves or a work project, where if you look at if it's a big project or a big goal, it can be really daunting when you look at it as this big hill that you've got to climb. But if you break it into smaller goals along the way, you can really get it done. So that was the idea behind this financial calendar. By plotting these various financial jobs month by month, can really help people tackle them and get them done and check them off their lists.
So in January, one of the first things you suggest that investors do is conduct a financial wellness check. How you go about doing that check, though, depends on your life stage. So let's start with those of us who are still working. How would we go about conducting a financial wellness check?
Well, I think you're looking for just a big picture read on how you're doing. So here I would suggest that people refer to some type of a calculator. So assuming that retirement savings is your main financial goal, as it is for many of us, you'd want to turn to a T. Rowe Price retirement income calculator, or Vanguard has its nest egg calculator. A lot of investors have their favorites that they might use, but look for a calculator that is holistic, that takes into account your proximity to retirement, takes into account how much you and your spouse have saved, that really takes an encompassing look at how you're doing. But plug in your variables. The good news is that 2020 was a really good year for the market. So many investors, assuming that they stayed put during that period of volatility in the first quarter, had a pretty good experience and have come out of 2020 in better shape than they went in. But plug in your numbers, see how you're doing toward your goal, and see how you're doing toward your contributions. If you haven't revisited your contribution rate, check to see how you're doing. Maybe you've gotten a raise in the past year. Perhaps you can bump up your contributions. That's one of the easiest ways to improve how you're doing toward your goals.
And what other things might retirees be thinking about when doing their wellness checks?
Well, for retirees, really the main number that tells them how they're doing is their withdrawal rate. So retirees should look at their withdrawal rates, make sure that they pass the sniff test of sustainability. And so I think there are a couple of things to say about withdrawal rates right now. One is that we have had a strong performing stock market. We've had a really strong performing bond market as well. So retirees are apt to see that their portfolios have grown nicely over the past year, really no matter what they invested in. On the downside, though, we have higher valuations on stocks. Bond returns aren't likely to be great going forward, in part because starting yields are so low. So even though you have a higher portfolio balance right now, you might want to think about reducing your portfolio withdrawal rate. And that's especially important for new retirees. So look at that withdrawal rate, make sure that it's on track. If you aren't sure where to start, we've certainly got lots of articles on this topic on Morningstar.com, or maybe check in with a financial advisor to get another opinion on your withdrawal rate.
Now, also in January, you suggest that households take a look at their capital allocation choices. What do you mean by that?
I mean that you want to think holistically about how you're putting your money to work. So most households have multiple opportunities that they could use to direct their money towards. So you don't just have your retirement portfolio, you might have shorter term goals that you're trying to reach, or you might have a mortgage or student loans or high interest rate credit cards. And so I think you want to think about the return on investment from each of these capital deployments and try to be putting your money toward the one that has the highest return on investment. So if you have credit card debt, for example, you're going to be really hard pressed to out earn the interest rate on those credit cards by investing in the market. Paying down credit cards would be the obvious way to deploy your capital. For a lot of us, it's more gray. So we might have mortgages, but the interest rates are really low. We might think we can out earn our mortgage interest by investing in the market, but really take a step back and think about all of those different opportunities where you might deploy your investment and try to use ROI, return on investment, to guide the way and determine where you put your money.
Now let's talk a little bit about retirement plan contributions. The new year seems like a good time to be looking at those as well. Is there anything we should be thinking about in particular with that for 2021?
Well, the baseline contribution rates are staying the same for 2021 as they were in 2020. So for 401ks, it's still $19,500. For people under age 50, it's $26,000. For people who are 50 plus, it's still $6,000 for IRAs, $7,000 for people who are 50 plus. Health savings account contributions are going up just a little bit in 2021. So people who are covered by self-only coverage in a high deductible healthcare plan can put away $3,600 in a health savings account. It's double that amount for people who have family coverage. So revisit those contributions. Certainly not everyone is in a position to contribute the max, but if you have gotten a raise or if you have just found it a little easier to save over the past year, as has been the case with many of us, you may find that you can, in fact, bump up your contributions. So revisit those if you haven't done so.
And let's talk specifically about IRAs, the idea of a traditional IRA versus a Roth IRA. Is there any advantage of one over the other or in 2021?
Well, it's a good question, Susan. And many people also have a fork in the road in their 401k or company retirement plans where they could make traditional or Roth contributions. And there are a few different ways to look at this. One general sentiment I would say is that tax rates today are quite low relative to historic norms. So if we talk to external experts like Ed Slott, who is a big proponent of Roth contributions, he would say this is really the time to think about making Roth contributions because you're paying taxes at today's low rates in exchange for tax-free withdrawals down the line. So that's sort of the secular case for making Roth contributions. On the other hand, Roth contributions aren't the right answer for everyone. The key profile I would call out would be someone who is working, but maybe sort of in the tail end of their career and who hasn't saved a lot for retirement. Well, even if tax rates go up secularly, that person may not pay taxes at a higher rate in retirement than they were when they were working. So it's not necessarily the right answer for everyone to make Roth contributions, but certainly if you're a young earner on sort of the early stages of your career, you're probably paying taxes at a low rate relative to what will be the case in the future. You may consider making Roth contributions. Roth conversions also look attractive from that standpoint. If you think tax rates will go higher in the future, check with a tax advisor. It may make sense to convert a portion of your traditional IRA balances to Roth.
Well, Christine, thank you so much for putting together this year-long organized program for all of us to follow, and specifically for talking with us today about our January to-dos. We appreciate it.
Thanks so much, Susan.
I'm Susan Jabinski with Morningstar. Thank you for tuning in.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.